Book Snapshot.
Hey everyone, and welcome to Book Snapshot. Today we're diving into one of the most influential investment books of all time, The Intelligent Investor by Benjamin Graham. Known as the father of value investing, Graham's teachings have shaped the careers of legendary investors like Warren Buffett, who calls this book the best book on investing ever written. But here's the thing. The Intelligent Investor isn't just for Wall Street professionals or finance experts. It's for anyone who wants to build long-term wealth through smart, disciplined investing. Whether you're a beginner or a seasoned investor, this book offers timeless principles that can help you navigate the stock market with confidence. So, let's break down the key lessons and strategies from this investing classic. By the end of this video, you'll understand why this book is a must-read for anyone serious about building wealth. Before we dive into the book, let's talk about the author. Benjamin Graham was a pioneering investor, economist, and professor who revolutionized the way people think about investing. After losing money in the stock market crash of 1929, Graham developed a disciplined, value-based approach to investing that focused on minimizing risk and maximizing returns. His most famous student, Warren Buffett, credits Graham's teachings as the foundation of his own success. In fact, Buffett has said that The Intelligent Investor is the single most important book he's ever read. Graham's philosophy is built on the idea that investing should be approached with the mindset of a business owner, not a speculator. This means focusing on the intrinsic value of a company rather than short-term market fluctuations. One of the key themes in the book is the distinction between an intelligent investor and a speculator. Graham defines an intelligent investor as someone who focuses on the long-term value of an investment, conducts thorough research and analysis, avoids emotional decision-making. On the other hand, a speculator is someone who tries to predict short-term market movements, relies on tips, trends, and hype, takes unnecessary risks in pursuit of quick profits. Graham warns that speculation can lead to significant losses, especially during market downturns. The intelligent investor, however, stays disciplined and patient, knowing that the market will eventually reflect the true value of their investments. One of Graham's most important concepts is the margin of safety. This is the idea that you should only buy a stock when it's trading at a significant discount to its intrinsic value. In other words, you want to buy $1's worth of assets for 50 cents. The margin of safety protects you from errors in your analysis and unexpected market downturns. For example, if you estimate that a company's intrinsic value is 100 per share, you might only buy the stock if it's trading at 100 per share. You might only buy the stock if it's trading at 70 or less. This gives you a 30% margin of safety. Graham emphasizes that the margin of safety is the cornerstone of intelligent investing. It's what separates successful investors from those who lose money in the market. To explain the irrational behavior of the stock market, Graham introduces the concept of Mr. Market. Imagine that Mr. Market is your business partner who offers to buy or sell shares of your business every day. Some days he's overly optimistic and offers high prices. Other days he's pessimistic and offers low prices. The key lesson here is that you don't have to accept Mr. Market's offers. Instead, you should take advantage of his mood swings. When he's overly pessimistic and offers low prices, that's your opportunity to buy. When he's overly optimistic and offers high prices, that's your opportunity to sell. This analogy teaches us to ignore short-term market fluctuations and focus on the long-term value of our investments. Graham divides investors into two categories: defensive investors and enterprising investors. Defensive investors. These are passive investors who prioritize safety and simplicity. Graham recommends that defensive investors focus on high-quality, low-risk stocks and bonds. Diversify their portfolio to minimize risk. Avoid trying to time the market or pick individual stocks. Enterprising investors. These are active investors who are willing to put in the time and effort to analyze individual stocks. Graham advises enterprising investors to look for undervalued stocks with a significant margin of safety. Conduct thorough research and analysis. Be prepared for the possibility of losses. Graham emphasizes that most people are better off as defensive investors, as active investing requires a significant amount of time, skill, and emotional discipline. Another key principle in the intelligent investor is diversification. Graham argues that no matter how confident you are in a particular investment, you should never put all your eggs in one basket. For example, if you invest in individual stocks, you should spread your investments across different industries and sectors. This reduces the risk of losing money if one company or sector performs poorly. Graham also recommends balancing your portfolio with bonds, which provide stability and income. The exact allocation between stocks and bonds depends on your risk tolerance and investment goals. One of the most underrated aspects of investing is psychology. Graham warns that emotions like fear and greed can lead to poor investment decisions. For example, fear can cause you to sell during a market downturn, locking in losses. Greed can cause you to chase speculative investments, leading to unnecessary risks. To avoid these pitfalls, Graham advises investors to stick to their strategy and ignore short-term market noise. He also recommends keeping a journal of your investment decisions to track your thought process and learn from your mistakes. For instance, during the 2008 financial crisis, many investors panicked and sold their stocks at the bottom of the market. Those who stayed disciplined and held on to their investments, or even bought more, saw significant gains in the following years. Graham's advice is simple but powerful. The investor's chief problem, and even his worst enemy, is likely to be himself. By staying calm and rational, you can avoid costly mistakes and stay on track toward your financial goals. Throughout the book, Graham's wisdom is complemented by commentary from Jason Zweig, who provides modern examples and insights. But perhaps the most compelling endorsement comes from Warren Buffett, who wrote the preface for the updated edition. Buffett shares how Graham's principles have guided his own investment strategy, emphasizing the importance of patience, discipline, and a margin of safety. He also highlights the timeless nature of Graham's teachings, which remain relevant even in today's fast-paced, technology-driven market. For example, Buffett credits Graham's concept of intrinsic value as the foundation of his success. By focusing on the true value of a company rather than its stock price, Buffett has been able to identify undervalued companies and hold them for the long term. Buffett also emphasizes the importance of continuous learning. He spends hours every day reading and studying, which allows him to make informed investment decisions. As he puts it, the more you learn, the more you earn. So, what can you do to apply the lessons from the intelligent investor to your own life? Here are a few actionable takeaways. Start with a plan. Define your financial goals and create a strategy to achieve them. Whether you're saving for retirement, a down payment on a house, or your children's education, having a clear plan will keep you focused and disciplined. Focus on the margin of safety. Before buying a stock, ask yourself, is this company trading below its intrinsic value? If the answer is no, it's probably not a good investment. Diversify your portfolio. Spread your investments across different industries, sectors, and asset classes. This will help you minimize risk and protect your portfolio during market downturns. Avoid emotional decision-making. Stick to your strategy and ignore short-term market noise. Remember, the stock market is a voting machine in the short term, but a weighing machine in the long term. Keep learning, invest in your financial education by reading books, taking courses, and following trusted experts. The more you know, the better equipped you'll be to make smart investment decisions. By following these principles, you can become a more intelligent investor and build long-term wealth with confidence. So what's the big takeaway from the intelligent investor? Successful investing isn't about predicting the future or chasing hot stocks. It's about discipline, patience, and a commitment to long-term value. By focusing on the margin of safety, diversifying your portfolio, and avoiding emotional decision-making, you can build wealth steadily and securely. If you're ready to take your investing to the next level, this book is a must-read. And if you've already read it, I'd love to hear your thoughts in the comments below. What lesson resonated with you the most? Before you go, don't forget to smash that like button if you found this video helpful, and subscribe to the channel for more book summaries, investing tips, and financial wisdom. Hit the notification bell so you never miss an update. Thanks for watching, and remember, the intelligent investor is a realist who sells to optimists and buys from pessimists. See you in the next video.